All right. Well, hello and welcome everybody to another leadership library series where we're going to be talking about the book, The Holy Grail of Investing. The world's greatest investors reveal their ultimate strategies for financial freedom. This is a book that was written by Tony Robbins along with the help of Christopher Zook. And so we should just jump right in. And before I continue, we have actually a lot of new members that are going to be joining now and be joining over the next month. So in case you're not familiar with who I am, again, my name is Tim Paul Duffy. I've been doing leadership training and coaching for over 2 decades now. I was part of the executive leadership team that helped create the largest leadership society in the country with over 1 million members. And I'm so grateful to that experience because I got to manage over 600 people and break records in sales and customer retention. And so it was just within the last, I would say in 2021 that we created Electus Society. And right now, at the time of this recording, we are, over 460 members, on track to be 500 members by the end of this coming month or so. So I'm really excited. For those you don't know, I'm the founder of Electus Society, and our mission is really to create more conscious leaders with real world skills. That means leaders with more humility, integrity, awareness, and who take constructive actions. And if you're not a member and you're watching this video, that's available, please visit the website to apply and join. So what are we going to be covering in today's training session? We're going to always start off with the same 2-minute grounding meditation for us to get centered and focus. We're going to have a networking discussion question. What is the best or worst investing advice you've ever received or experienced? We're going to learn about Tony Robbins' research based on all these experts. We're talking about people with millions and billions of dollars. What are their 4 principles for investing? And then it's not what you typically think, right? Because there's a myth that's out there that the higher risk, higher the reward. But we're going to be learning some different concepts, as well as Ray Dalio, the #1 most successful hedge fund manager and creator for his company that Bridgewater Associates. That's the name of his company that he created, the hedge fund. He is an expert in financial planning, right? He pulls together a bunch of different people who want to invest his money, and he gives his holy grail of investing advice. And so we'll talk about what it is. And guess what? The big hint, it involves one of the values of Electus Society, humility. We'll talk about non-correlated investments, the problems with the conventional wisdom and bubbles, and learn 7 different categories of alternative investments. So again, we're used to the traditional investments like stocks, bonds, treasury bills, commodities, gold, but there's a whole world of alternative investments that some of the most wealthy people in the world are using. And what was surprising to me is that 6% of their portfolios contain these alternative investments. So that was kind of mind-blowing for me. And then we'll end on some positive note, because then Tony Robbins gives a different definition of what he thinks is the truly holy grail for financial freedom. So let's jump right in. You feel free to turn off your screens. We're going to do a 2-minute grounding meditation. Let's start right now.
Hello there, and welcome to this 2-minute meditation for grounding. Begin by sitting in a chair with your feet touching the floor. Relax your hands on your thighs with your palms facing upwards, and close your eyes. Begin to breathe slowly, in and out, noticing the feeling of how the air expands and contracts your belly and chest. Relax your body from head to toe and begin to imagine yourself in a beautiful, calming forest. Stay here and just admire the view, the trees, the sky, feeling the grass under your feet. Maybe it's autumn here and you feel the fallen leaves under your feet. As you stay here, relaxed and still. Visualize how tiny roots begin to grow from the soles of your feet. These roots grow into the earth and make you feel grounded and secure. You now connect with Mother Nature's positive energy, making you feel so protected and loved. See how these roots begin to grow deeper and deeper into the earth, becoming thicker. Observe how you feel now, and when you feel ready, move your toes and fingers. Open your eyes and continue your day filled with centeredness, confidence, and compassion.
All right. What a great way to start off our training session. So let's jump in. So we're going to start off with a networking discussion question for our members to have a chance to share. What is the best investing advice you've ever received, or what is the worst investing advice you've ever seen? And this could be something that you've learned from others or that you personally had experience with. Who would like to go first?
Well,
Go ahead, Yomerly. Thanks so much for sharing.
so this is not really necessarily advice. It's like more like something that I've seen like my parents do very much all the time. Like they always like guess like numbers like in a lottery, like they buy like a few like Mega Million or Powerball tickets, or buy like scratch offs to like get like to see if like they win something. And like for for me, like I never really understood why um they like invested like spend so much money on like on get like guessing numbers and like buying tickets, and um where they don't really get as much as they spent playing,
Well,
which
I'm so glad that you brought that up, because we're going to talk about later in the training session, once we talk about some of these principles, whether do the wealthiest individuals ever play the lotto. So I'm not going to tell you the answer to this, but you'll have to watch the rest of the training. But from your experience, you would consider this, not good investment advice because they spend so many dollars trying to invest in the lotto. And let me guess, they haven't yet won the lotto?
no, like yeah, not really.
I mean, listen, I have people in my own family that invest in the lotto, and I'm just curious on what I know about the lottery is it's not about whether you win or lose. It could be a very fun thing for a lot of different people to play, but what happens when you win the lottery, right? Now you're flushed with all this money, and according to the stories, that the people who end up getting a flush of cash end up spending it all and going back to the same level of where they started in terms of how much money they made. And the reason why is because chances are they haven't developed the discipline to be smart with money, right? To learning how to invest it, how to use that money for constructive purposes. Because guess what? A lot of these things that we start to learn is, we are subject to our emotions, and we make emotional decisions, not necessarily rational decisions, and end up, suffering from those consequences. So, Yomerly, I really appreciate you sharing that insight from you and your family. All right. How about Henry? Do you have any other thoughts about best investing advice or worst investing advice?
Yes, absolutely. Thank you, Tim. I think the best investing advice I received is to ensure your investments.
Tell me more.
Anything that you're investing in
Mhm.
should put insurance on it. bring a third party to
Uh,
make sure that you're covered if you lose it, damage it, or any other thing may happen.
No, I love that concept because if you think about it, if you haven't yet watched the couple of trainings that I sent out as prerequisites, I'll also include them in the notes if people haven't a chance to watch them yet, such as creating wealth and abundance and prosperity, my stories of success and failure, where Henry actually joined me on that call and did a joint presentation. And one of the things that we know that an asset is something of value that actually puts money in your pocket. So for example, a home is not necessarily an asset, but if it provides you rental income, right, that you rent out a portion of that house, that's an asset and it's giving you cash. Well, anybody who is depending upon that asset to provide that income, they're going to have insurance, right? What if something happens to them and that what happens to their house, for example, they need insurance to make sure that they can recoup that investment and not lose that. And the same thing is with people's lives, right, Henry? Where it's like, what if you are married and you have a partner and they're the sole provider, or maybe you're also working and providing, but if you lost that income, what would happen? Could you still live in that same home in that same area to pay those taxes or whatever it is? Chances are not. So that's why people get life insurance, right? Term or other forms where if this person dies, a good life insurance policy, you know this, Henry, isn't just, oh, here's $100,000 policy, here's a $200,000 policy. It's how much does that person make a year? And if they were to die, could that income be replaced in that insurance? So for example, if you had $1 million policy, well, guess what? You could use that $1 million, invest it, and then you could have an income of $100,000 or whatever, to be able to do that. Anything else to add, Henry, beyond that?
Oh, yeah, I was just going to add on to that, Tim. You're right. A lot of times when we think of insurance, we think short range, just in life or car. But yeah, the range of insurance is anything that you invest in, 9 times out of 10 can be covered with some type of insurance policy. So yeah, thanks, Tim. You're absolutely right.
Awesome. Thank you for sharing. And also, any other people who've joined, feel free to post in the chat what your thoughts on the best investing advice or worst investing advice. But let's keep going for the sake of time. So now let's jump into the content. So based on Tony Robbins' research, he evaluated what are 4 fundamental principles of investing that he learned from interviewing all these very successful people, hedge fund owners, venture capitalists, whatever. The first concept was don't lose money, which I thought was kind of funny. But people don't really realize the power of this concept. And when there's a quote from Warren Buffett, who is one of the most successful investors, who owns Berkshire Hathaway, that's invested in Coca-Cola and other of the biggest companies. He says, for the rules of making money, rule number 1 is don't lose money. And rule number 2 is please see rule number 1. And the reason why this is important is because people might think, well, the more time I invest in certain things, the greater the chance that I'm going to get money back. But if you're not choosing your investments wisely and you invested money into something, let's say, $1,000, right? And hoping that that would grow, and then suddenly, boom, you lost half of its value. What did I say? $1,000. Now it's only worth 500. You've lost $500 of that investment, right? But if you invested another investment and it's in $1,000 and it gained in 10%, so now you have 1,100 or whatever, you still are in the hole with these 2 investments, right? Because you lost 500, you gained 100. So smart investors try to predictably and accurately ensure that they're always not losing money and that their money is continuing to grow for them. So the next principle that I had never heard of this term until I read this book and heard Tony, is smart investors invest in things that are called asymmetric risk reward. So what does that mean? It actually means minimum risk versus maximum reward. So for example, they talk about, okay, if you, a smart investor, who has billions of dollars, they're going to do a 1-to-5 risk reward ratio. So what does that mean? It means I'm willing to put a $1 to risk my $1 only if I'm going to get a minimum of $5 in return. So if you think about it, if I invested in 5 different companies, and let's just say I'm giving them $1 to help grow their business, but I expect them that they return on my investment is that I'm going to get $5, and I give these 5 companies, well, what happens if those 5 companies, some of them fail or they don't deliver and don't give me my return on investment? What if one of them doesn't pay me back or 2 of them don't pay me back, because in the end, they say they're going to pay you back with interest and have a return, but people are unreliable. There's changes, the economy, the market, whatever it is, we can always be wrong. But if I did my risks to reward ratio right, and some didn't turn out, well, guess what? I still won. I only invested $5 of my money. I was expected 25, but maybe I only got $10 back, right? Because, some of the other companies didn't turn out. I'm still a smart investor because I'm still growing and not losing any money. So you can see how this applies to the first principle. Now, understanding this minimum risk, maximum reward, well, that goes back to what Yomerly was talking about with the lotto, right? Would a wise investor play the lotto, right? Isn't it like a minimum risk? I'm just putting $1 in there, and then I'm suddenly going to get millions of dollars or $1 billion jackpot if I win? Well, not necessarily. So according to this, a wise investor would definitely not invest in the lottery. Why? Because even though you see you're only giving a $1, the chances of you actually are winning is very, very low. And this was some research that I found out. The chance of winning a Powerball, 1 in 292 million chance. Mega Millions, 1 in 300 million plus chance. And guess what? You have a higher risk of being struck by lightning, 1 in 15,000. So again, it seems like you're only putting in $1, but the risk is, what is the probability that I'm going to get my money back of what I put in? If it's very low, then it's actually considered a very, very high risk, no matter what the high reward is. So this reminds me of the first book by Tony Robbins that he talked about financial planning. It was called Money, where he did interview a bunch of different millionaires and billionaires. And this hedge fund, guy, whoever it was, said, if I had an opportunity to do one investment that I could guarantee, like let's say it was buying nickels that were actually originally made in silver, and I would then sell them. And he's like, in that book, he's like, I would have taken 100% of all my portfolio of money and did just that because I knew it would be a guarantee, right? But he wasn't able to do that. So it just got me thinking, wow, smart money doesn't operate on this principle of, oh, well, the higher the risk, the higher reward. No, 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 no. They don't operate on that principle. They talk about minimal risk and high reward. That's how smart money works. And so a perfect example of this asymmetric risk reward would be in this book that I read that I talked about in my first training, creating wealth and abundance, my stories of successes and failures. I read the book The Richest Man in Babylon, and that book blew me away because it talked about smart investors are not going to lend or give their money to people who have low credit worthiness and that are not sure that where they're going to pay them back. They have to guarantee that they're going to get their money back. So the perfect example would be of an asymmetric risk reward would be a pawn shop. So if somebody says, hey, I have a gold ring, but I really need to borrow some money. What if I go into the pawn shop and say, hey, can you lend me $250? I'll pay you back with some interest, maybe $350, in the next 3 to 6 months. And if I don't pay it back, my ring is held as collateral. But guess what? If I'm the pawn shop owner, I'm going to say, that's a good bet. You want to know why? The ring might be worth $500. So even if I don't get my 250 back, I still win. right? I still get to keep that gold ring. Or if the guy does pay me back, or the person pays me back, not only did I get my 250, I also got interest. That's a guarantee. So do you see how that's understanding this principle of minimum risk and maximum reward? Why do you think we all have credit scores? Is because the financial industry needs to determine who are the people who are responsible that can handle giving them a lot of credit and will be able to pay their bills on time and be financially responsible. The people who are better at that will be given better deals, better lower percentage rates of APR, and are much more likely to get that money because they can guarantee that they have a greater chance of getting a return on their investment. If you don't have a high credit, well, guess what? I'm going to charge you much more because I need to recruit my money fast and quickly, because if you don't make the payments, I need to make sure that I get my money back. So it's some banks and other things are willing to take more risks than others. The third principle of investing, and this is something that we've talked about on the several of the trainings, is diversification of different asset classes. So there's our different classes of assets. As we know, there are stocks like the stock market, bonds, like when companies or municipalities, governments will want to build a park and they're like, okay, we're going to put up a bond, borrow some money and then we'll pay it back over time, right? So companies do it, governments do it. The US government has US Treasury bonds. Then you can invest in real estate. You can invest in gold coins, right? Sometimes there's also a paper market for gold, other commodities like oil, wheat, all this other kind of stuff. These are traditional asset classes. So you would never want to put all your eggs in one basket, So some people just say, well, I'll just put my money in the S&P 500. It's low fees. My 401k is going to go there. Yeah, that's great. That may be smart because it's a diverse portfolio of the 500 best companies, and that they're weighted. The better the companies, the more money they make, the greater the percentage of that they make up of that S&P 500. It's weighted index. Well, that's great, but it's all stocks, right? So you're not diversified enough. You have to go to different things. So this is something that I've already known and we've talked about, but here's the kicker. It's not just diversification of asset classes. Here's principle number 4. We need to have a diversification of alternative assets. These are different alternative asset classes with a varying risk to reward ratios. So in this presentation, I'm going to talk about each of these 7, but I'm going to give a kind of a recap for you right now what they are. Number 1 is private equity, okay? The second is owning sports teams, right? The third is private credit. The 4 is the energy market. The 5th is venture capital. Those are new businesses, right? Like startup companies. Then there's 6 is private real estate. And then the 7th one is something called secondaries. It's high quality assets on sales. Okay, so let's jump right into these. So here's the recap of Tony's research. Don't lose money. Invest in asymmetric risk reward. That means minimal risk, high reward. Diversify across assets, and you really need to diversify on your alternative assets. And this was the shocking statistic that I learned by reading this book, is that the majority of the millions and millionaires and billionaires, half of their portfolio is this stuff, alternative assets. I would have expected it was a mixture of all the things. They definitely have these, but if almost half of your portfolio is this, there's something that the millionaires and billionaires are doing. Well, we need to learn a lot more about it. Okay. So where did this whole concept of the Holy Grail of investing come from? It came from Ray Dalio, the most successful hedge fund founder of Bridgewater Associates. So here's what he actually said. He said, from my earlier failures, I knew that no matter how confident I was in making any one bet, I could still be wrong. And that proper diversification was the key to reducing risk without reducing returns. If I could build a portfolio filled with high quality return streams that were properly diversified, they zigged and zagged in ways they all balance each other out. I could offer them an overall portfolio of return that was much more consistent and reliable. And then we could actually get somewhere. So this is how he was so successful. And so for him, the Holy Grail of investing, or the Holy Grail of portfolio, is 8 to 12 uncorrelated or non-correlated investments, which means altogether they will dramatically reduce the risk of your portfolio without sacrificing the return. Okay, so let me give you a little bit more detailed explanation of this. So when I was, starting out in my professional career, when I had my first job, one of the things that they say, okay, Tim, you can start donating to a 401k. And so we met a financial planner, and this is what the conventional wisdom was. And I've met other financial planners, and they all say the same thing. Stocks, ooh, they're risky, but have a high return, on average 9 or 10%. Bonds are less risky. They're much more safe, but they have a lower rate of return, around 5 to 6%. But if you had a diversified portfolio of stocks and bonds that my 401k was, the company that was associated with trying to sell me, you should just have both, right? But it's, what is your risk tolerance, right? Higher the risk, the higher the reward. So what they recommended, be risky when you're young, invest in a lot of the stock market. And then as you get older and you really move towards retirement, you need to be less risky because you can't afford to lose a lot of money. So then you'll go out of stocks and you'll go more into bonds so you have income from retirement, right? How many people have actually heard this advice, right? Diversify, stocks are risky, bonds are safe. Well, guess what? That is no longer applicable. Why? Because in 2022, stocks and bonds both dropped at the same time. Okay. Between 2010 and 2020, remember, people say diversify portfolio, invest in real estate. And if you don't want to buy a home, maybe you can invest in REITs, which are real estate investment trusts. Well, guess what? We're starting to find out, right? They had an 80% positive correlation with the S&P 500. Now, and then even Bitcoin, right? In 2022, Bitcoin, they're like, oh, I need to invest in cryptocurrency. I can't trust, US treasuries and all this. I need to have some alternative investment. Well, Bitcoin dropped in 65%. Was at 47,000, and then wow, it dropped all the way to 16,000. So it's like, what's really going on right here? Now, if you watch my last leadership library series about, financial crisis and a leader guide to money, you'll realize that we're living in right now, this is July 2024, in a stagnant economy. And right now, we're really dependent upon the Fed, right, to adjust interest rates that are really affecting the markets that we have. There's a term, don't fight the Fed, because whenever the Fed reduces the interest rates, and so a lot more people can borrow, credit is created, right, from the buying and selling of US Treasury bonds. Well, guess what? Guess what happened? Woohoo! Stock market celebrates. We're all excited. We go back to zero interest rates. We can get easily money and capital. Companies use that to buy back their stocks, and they go up. And so guess what? Now we're starting to see a positive correlation that whatever the Fed does, that affects practically the economy and the stock market. And if the Fed is easing monetary policy, well, guess what? There's more money. Guess what people do? Wealthy people, they buy more Bitcoin. And so they're starting to see all this correlation. And guess what? Like what we thought we knew is no longer applicable. And this is why I think this training is so important, is because we constantly need to be striving to learn new information that we didn't know before. Because what is humility? Humility is the idea that you could be wrong. And that's why I really appreciate Ray Dalio and others that are basically saying is like, Tim, all the financial experts cannot guarantee, what is going to happen in the future. We just don't know. All we can do is, based on the preponderance of evidence, find different opportunities, minimize risk to have a guaranteed return, or as much as possible. That's all you can do. All right, got it. And so what we know today is maybe no longer applicable tomorrow. So that's why we have to be very careful of this kind of herd mentality. It's like, oh, everyone seems to be going this stock, or this is going really up and up and up. But is it going to go up forever? Right? That's something that's really important. So right now, what I just want to take a little tangent to see how this applies into our daily lives. Now, I had just recently had a friend who told my wife, oh my goodness, you have to invest in NVIDIA stock. Okay. Who here knows what NVIDIA is? Please let me know in the chat. It's like if you've heard or maybe you've invested in Nvidia, it is on the stock market. It's part of the S&P 500, and it has gone to trillions of dollars of market cap. Like, oh my God, so many people are investing into it. Why? It's because this craze of artificial intelligence. It's like, oh my goodness, we have to invest in AI. And this is the company that invests in the chips called learning language models, LLMs, that are going to, be responsible for all the innovative technology. So you got to invest in them, and their market cap keeps going up and up and up and up. And it's like, you can't lose. You have to invest in the future. Well, guess what? Remember how whenever it's very easy to spot a bubble because it means everybody else is piling in because why? Because of greed, right? Everybody wants to make money. And so if they see everybody else making money, they have FOMO and they don't want to lose out. So again, this is a podcast that I like to listen to. Scott Galloway, if you don't know who he is the professor of the New York University Stern School of Business. And he has this podcast that he talks about companies, investments. He always starts off his podcast with a joke. He has a little potty mouth. He admits it that he likes to curse and can, be a little absurd sometimes, but, it's entertaining. But I sometimes listen because I want to have a pulse check on how businesses are doing. And guess what? Even this professor knows, he's like, I think a bubble is forming with AI. So again, I'm seeing how much time we have. I want you to show you this clip. And again, this is not for me. This is a guy who's made successful millions and millions of dollars investing companies, guiding them on companies and markets and things like that. So let's watch this clip right now.
Away by it. I'm starting to believe that an AI bubble is beginning to form, because what happens if the expectations around what you can do with AI at your Fortune 5,000 company that makes cardboard boxes or supply materials or textiles, if the AI dream doesn't live up to your hopes to revolutionize your business and you begin reducing your spend, the first quarter that comes out that shows that sort of medium and large size businesses are cutting back their spend on AI, wow, that could be really ugly around these companies.
Yeah, I mean, I wanted to ask you about that because, one read of this news is, wow, AI demand is growing, but another read would be that things are getting super frothy. I mean, $10 billion is so much money, and it feels as though the only reason they're really doing it is to just follow the pack. Anthropic signed a deal with Amazon, OpenAI signed one with Microsoft. Oh, we should sign one with Oracle. Now, when we discussed this earlier this week, you said that this kind of reminded you of Cisco in the late 90s and the early 2000s. Tell us why Cisco comes to mind here.
Well, we got very excited around the internet. There was a Netscape browser, then there was Internet Explorer, and it was clear that the internet was going to be huge. But then somebody realized that Aardvark Pet, which was my e-commerce pet supply company that I started, thinking that there needed to be something, a Williams-Sonoma of pet stores online. My idea, true story. $500,000, built the website, sold it 9 months later for $3 million to Petopia. You were, I think, probably, my God, I don't think, were you even born then? Yeah, you were like maybe 2 or 3 years old. Anyways, when we all realized that this wasn't happening as quickly as we were hoping, that there were a lot of companies that just weren't selling anything, or if they were selling things, they were basically buying consumers. They were buying a Furby for $300 for Cybershop and selling it for $99, or they were selling a 70-pound bag of dog food that costs $100 to deliver for $19.99, pets.com. And everyone said, okay, the internet might work or e-commerce might work, but it's definitely not going to work anytime soon. The unit economics here are shitty. And all the front end B2C stuff crashed. But people still thought, okay, but the internet is not going anywhere. So what do we do? Well, we can invest in B2C. Let's find B2B. And they started investing in these ridiculous B2B platforms. ICG was one of them that was going to figure out a way for people who were purchasing supplies in the drinks or the chemicals industry to meet online. And that was a total fucking jazz hands ridiculousness. And that thing crashed. So everyone's like, well, okay, B2C is not working. B2B is not working or living up to our expectations. What do we do? And I'm like, well, we still believe in the internet. Let's invest in infrastructure. And everyone piled into Cisco, which became the most valuable company in the world in the late 90s. What people forget is that similar to Amazon between 1999 and 2001, Cisco and Amazon shed 90% of their market value. Now, they came back, Amazon came ripping back. Cisco never really fully recovered. It came back, but never touched those same highs again. Amazon came back and more, was one of the winners that got through kind of the valley of death, if you will. So the question here is the same thing forming. Do we have the same level of excitement that we had in, say, 97, 98? And then when it appears that every company may not spend tens of millions of dollars to use AI to change the way they do business in any industry, and these companies report for the first time that their fairly scant, mediocre revenues to date actually are flatlining or even declining, you could see the mother of all. You could hear a pop that is a sonic boom. AI infrastructure investments, $200 billion, up more than 35%. Valuations from the AI boom, right? 120 times the estimated 20 billion in revenue that Gen AI will add in 2024. Now, what's that multiple? The combined market value of Alphabet, Amazon, and Microsoft has increased $2.5 trillion. So we have $2.5 trillion in increased value during the AI boom, but the increase in revenue has only been 20 billion. So the market has valued the $20 billion increase in AI revenues at $2.5 trillion, or 120 times revenues. The big three cloud providers traded an average PE of 38, which is significantly higher than the broader S&P at 23. In October of 2022, public AI hardware companies were worth about $1.5 trillion. Today, they're worth about $5 trillion, and NVIDIA has accounted for 57% of this increase. So if I had bigger balls, I think I would probably create a basket of AI companies and think about shorting them, because
Big claim.
well, this is beginning to feel like 1998. And the problem is when guys like me say something is overvalued, that means it usually runs up another 30 or 70%. And then I throw in the towel and then it crashes. It's very hard to time the markets. But I mean, I do learn a lot on this show, just as we're talking about this and I'm reading these numbers, I've been here before.
So I think that's very powerful stuff that sometimes we don't actually hear many times in these different videos or what we're listening on the media. And I think that's why I really wanted
This
to
is literally
hold on one
26
second.
years ago.
That's why I really wanted to show it to you guys here. And there's one other video that I really want to share with all of you that has to do with AI that really kind of highlights this bubble. Again, here, let's play this clip right now. Hold on.
Hello and welcome to Factually. I'm Adam Conover. Thank you so much for joining me on the show again. Every once in a while.
The problem is with AI,
They do something.
they do something. And that is also the problem, because AI as a concept been around a while.
Yeah.
Like decades. And
It's a very loose term. It can be used to describe a lot of things.
exactly, which is great for companies like Microsoft. So Satya Nadella, 2021, says that he could not overstate the breakthrough that the metaverse was.
Yeah.
2 years before that, he said that HoloLens 2 was a breakthrough.
Their AR goggle thing.
Yes,
Yeah.
which have now been, but they exist, but he's fired most of the team.
Yeah.
And Satya is now major beneficiary of the OpenAI boom. They've put $13 billion in, they've invested early, and they invested $10 billion, mostly in Azure credits, so their cloud services. The thing is with AI is it smells like the future. It has a feeling of the future. And when you say AI, people will fill in the gaps. Autonomous agents that do things for you. A super smart friend who knows everything about
Right.
you.
It has the advantage of it's at least been around in science fiction enough that the public knows what it means. You had to explain what crypto was and what the metaverse was, unless someone had read like Snow Crash or Ready Player One. But artificial intelligence, oh, I know what that is. That's the computer that talks to me from every movie I've ever seen.
From her.
Yeah. From 2001, from the movie AI.
What I love is when they quote these movies like great things for AI, like 2001, the movie that classically ends with the computer helping the guy. But with AI, what's interesting is it has both the smell of the future, but none of the taste, because the idea of what AI could be, this autonomous thing that does things for you, to quote Sam Altman, a super smart person who knows everything about you, all these things sound plausible, and you can, with ChatGPT, approximate something that sort of feels like it kind of.
Yeah.
But the problem they have is all these companies are promising a thing that is not there.
Yeah.
So Super Bowl commercial for Microsoft's Copilot. During it, there's a bit where it says, write the code for my 3D open world game. He hits it and then it cuts away before you actually see what would come out. So the problem with that is not what comes out. I've typed this in many times because I'm a little bitch. And it just gives you a guide for doing it. And it's like it's like an SEO article, like, first you code the game. Microsoft can't even show you why you should give a shit about this thing on their Super Bowl commercial.
Yeah.
They can't actually explain what it does today, so they have to talk about the future. Sam Altman, worst of them, talks about what it could be, what it will do. It'll be like a virtual brain, all these things. And the thing is, the people in the markets, the Jim Cramers of the world, the CNBCs of the world, much less Bloomberg. Bloomberg has done some excellent journalism about AI. Not so much with CNBC. Those and like Hayden Field there is great. But nevertheless, the markets people just go, and artificial intelligence is the future.
Yeah.
And this is good. And thus they kind of buy the bullshit train. But then the consumers get these things. They get ChatGPT. They get Copilot, what have you. And then they say, now what?
Yeah.
What's this meant to do? What's it do? And I'm sure some person will now email me and say, oh, well, actually, it helps me with my productivity. And every time you ask them to explain it, they say, well, first of all, I sat there and I did all this stuff. It's like, no. Okay, shut up. I don't care. Because
now, again, I could keep showing you more videos of this where he basically says that this is not, this is really hype, right? I actually took a screenshot of I have a Gmail account, and I see that, oh, they have this new AI feature, Gemini, and this is going to help you increase efficiency. Get it free for 2 months, and then you can pay. And then I watch videos on it, and it's like, wow, this is going to be so amazing, because when you write an email, let's say you went back and forth with a bunch of emails, you can ask the AI bot to summarize everything that has happened in all those emails. It's like, well, what if they miss stuff? And so this whole idea of, the reason why I'm bringing this up is because I want all of you as to help empower you and educate you and give you different perspectives that, greed will cause you to be delusional and not see the forest between the trees and the forest. And we see trends and companies like OpenAI, like Google, like Microsoft are doing this, but behind what's really there. And so that's why it's very prudent for you to be a very savvy investor. And it's a bubble, and you can make some money off the bubble, like Scott Galloway said. But what ends up happening is, will it continue? And sometimes it doesn't. And maybe it might go up for a little bit, but then it's going to come crashing down. So again, to be a smart investor is to be one that has the emotional fortitude to say, okay, I may invest a portion of money here, but if it goes up tremendously, I'm going to take some of those profits and pull them out and let the rest of my money that I've invested, if I invested 1,000, I've already made 1,000 back, or 2,000, I'll pull 1,000 back out, and I'll let, like they call that in gambling, use the house's money. If you invested and made some money, take the money out that you invested and then just play and see where it goes. But again, that's what smart, disciplined investors do, but why a lot of other people are not able to actually do that. So let's keep going. Well, the other clip in this video also talked about Sora, this famous whatchamacallit, this famous this AI video generator. And what happened with Sora is, I don't know if you guys are familiar with Tyler Perry. He's famous, actor, producer, director who did Medea's House and all these other kind of famous, traditionally movies that are very popular. Well, he was going to build a studio over, I don't know, I'm guessing $600-700 million or something to that effect. Don't quote me on the exact number. And he saw Sora, this AI generated video platform. And then suddenly he's like, I'm not going to invest in it because this AI is the future. I'm not going to spend all this money. But guess what? You realize if you look at Sora, it's like, oh, wow, we show this video image AI generated of this woman walking in Japan or Tokyo walking down. Well, guess what? if you ask to edit that video, hey, can you just make it a little bit different? No, it can't do it. It doesn't have the capability. It will take you 10 minutes to 30 minutes to make a 5-minute video, and you can't tell it to do things differently. It would be cheaper for a person to get a handheld camera iPhone or whatever Samsung phone and take a person walking down the street, and you would spend less money and less energy than having AI create all these videos. So again, my reason in sharing this is conventional wisdom. What does the conventional wisdom say? AI is the future, and now you're hearing different perspectives that AI may not be the future. Okay, so let's keep going. Then now we're going to jump into the 7 principles that, according to these millionaires and billionaires, of what do they do as alternative investments. Okay, so these are the first one that you need to know about is something called private equity. Now, what is private equity? Well, there's companies that are listed on the stock market, and then there's companies that are private that you don't know about because they're not listed on the stock market. When I researched all the private companies, these were 3 of them that are part of the largest private companies in the world. Have you guys ever heard of Mars? Where you buy Snickers and candy bars and things like that? Well, they're a private company. They're not listed on the New York Stock Exchange. You have Enterprise Rental, car, right? That they own Alamo, Enterprise, and National, all 3 brands. Some of you may live in Florida or throughout the country. There's a supermarket, food and pharmacy store called Publix, which a lot of people like. They're a private company, not owned by the public. So what private equity means is these are people who are accredited investors. Now, what is an accredited investor? That is, according to the rules and standards right now, is a couple or a person that makes $200,000 to $300,000 in annual income. Okay, and or has over $1 million worth of assets, not including a home. So right now, these are accredited investors. They have the ability to use their capital to invest in different things, and they will pool their money together towards those investments, and they will guess what? They will either acquire or buy private companies or invest in private companies. So as Tony Robbins and Christopher Zook, who are writing this book, they say right now, Congress, specifically the House of Representatives, wants to change the rules so that Joe Schmo, you, me, even if we're not making $200,000, $300,000 a year, that we can become accredited investors either by taking a test or we can invest some money so we can have the opportunity to invest in these private companies, because right now we don't have it. And so it passed the House of Representatives. It has not passed the Senate, but hopefully in the future those rules will change. But so it's something that we have to keep an eye out on. So what do these accredited investors they do? They basically say you can become an accredited investor, and if you have a lot of money and you talk to another person, we pool all this money together, right? And then we're going to lend it out to these private companies. Okay, and we either invest in them or we own them. All right, and so why is private equity so great for investing, according to all this research? Well, there's several reasons. One, if you become a general partner of this pool of funding, well, guess what? Just because you're a general partner and you've pulled this whole pool of funding together, just because you have this portfolio of $100 million, guess what? Because you did that together, you're going to get a management fee. You're going to get 1 to 3% of the portfolio annually, just for being responsible for putting together, right? Nice cash flow. Then there's a performance fee. What if one of the companies that you invested in or bought, really went up in profits? Well, guess what? I want a piece of that profits, up to maybe 20%. Right? Then we're going to actually use this pool, and because we're smart business people, we have a lot of contacts, we have a lot of networks. We're going to find really good companies and we're going to evaluate them. And guess what they're going to do? We're going to make them even better, right? So we find out what they're doing. Well, oh, there's a market, there's people, customers love them, but guess what? Their systems are outdated. Oh, we can actually get them a big client or whatever it is. And so we're going to turn these good companies into great companies, and we're going to add so much more value. And guess what? We're going to benefit from that. And we're also going to diversify, because we're not going to just invest in one private business. We're going to invest in a whole bunch of private businesses from a lot of different sectors. So you're starting to see why private equity is such a lucrative area that you would want to invest in. The second area is pro sports ownership. Okay. So this was so fascinating. There's the NBA that has to do with basketball, NHL that has to do with hockey, the MLB, the Major League for Baseball, the NFL, and the Major League of Soccer. So these are all major sports teams, right? There's all these people who come to the game, and you can see a crowd watching a game. There's the Coca-Cola advertisement, Coors Light are advertisers. So this is a very profitable business for you to own sports teams, even if it's just a piece of the sports teams. Why? There's so many reasons. When you're an owner of a sports team, you get a portion of the revenue. Whenever you have to broadcast that sports, right? People will get permission to different different things to actually share that game with others. You're going to get some profit off of that. So sponsorship as well. Local media, you're going to get benefit from that. Now, if you own a sports team, some people own surrounding real estate, right? Dealing with that stadium, with that sports team. So that means there's fees for parking garages, for hotels, to retail, all this other stuff that could be profitable. Licensing and sponsorships, tickets and concession stands, you get a piece of that. You could even have luxury boxes and suites, which cater to wealthier people, and wow, they're willing to pay much more for high-end experiences. And then there's also gambling now that certain states are passing laws to allow different types of sports gambling, and so you can benefit from that as well. So you're starting to see that this is a very lucrative opportunity to have investments in. The third area is called private credit. And this is a way for established businesses to borrow money without going to banks. So if you and I needed money, well, the first thing that we're going to think of is we're going to go to a bank. We're going to say, hey, TD Bank, Citibank, I want to, buy a home. I want to get a personal loan, whatever it is. That's where we get most of our typical money. But if you're a business, you don't have to go to the banks, because banks can have all these different kind of rules, right? Hey, I'm going to get a 30-year fixed mortgage. That's just me as an example, as me as an individual. But what about a business, right? That may be different. Oh, I'll get a loan of whatever amount. But if I can go to private credit, so these are companies that are willing to give money to my business, and I'll pay them back, but they're not going to be on the same terms as maybe traditional banks might have. So why is private credit so good? Well, guess what? Based on the history, or at least recent history, they are showing higher rates of return than traditional US Treasury bonds, traditional stock market, company corporate bonds, and stuff like that. So that's pretty good. And another thing is less interest rate risk. Okay, what does that mean? You see, if I were to buy a home, they would basically say, okay, Tim, let's give you a 30-year fixed rate. Okay, so I'm going to buy a home that's, whatever, $500,000. I'm going to have a certain mortgage, a certain percentage, 5%, but they're going to lock me into that rate. So if interest rates rise, I'm still going to pay that 5%. I'm not going to pay any more or less. But if you're a private, if you're a company that's dealing with private credit, you're going to lend to a business. Hey, business, private business, I'm going to lend you money, but it's going to be a floating rate. I'm going to give you at 5% interest right now, but if interest rates rise, well, guess what? The interest that you have to pay me back has to rise. So that sucks for the business. That would suck for me if I bought a home and I got a flexible rate, and if rates go up, then I have to pay more money to the bank. That would suck for me. But on the other end of an investor who's lending me that money, that's awesome. If interest rates rise, I want to make sure I get my money, So again, this is something that private credit does that, traditional banks don't do. Higher stability, lower default rates. Why do they have lower default rates? Well, a bank, a car company will lend you out money based on maybe your credit score. They may be willing to risk it. But if you're a private credit company, you're going to do real strict research on the credit worthiness of that company. You're going to have great underwriting standards. And what they found is in the last 10 years, that means 2008 financial crisis, COVID, or maybe it's 10 to 15 to even 20 years. They've had less than a 1% default rate, despite those big challenges. So that's pretty amazing that despite those big things, private companies who have to pay back people that are lending them money don't typically default. So that's a really, really good sign that would be a good investment to be part of private credit. Now, the fourth category has to do with energy. Now, I'll tell you right now, Tony Robbins uses 2 chapters to talk about energy. And I think it's very, very important because right now, bottom line is economic growth is highly correlated to your energy use, right? As we become more and more of an advanced technological society, if you have access to cheap energy, your GDP, your growth is going to go up. If you don't have access to cheap electricity, and it's cost much higher and higher and higher, you're not going to succeed as a business, or if you're a country, your GDP is going to go down. And so right now, we get our energy from a variety of different sources. The number one is petroleum, so oil. That's where we get most of our fuel, how we fill up our cars and things like that, how we heat up certain homes. Then the next biggest is natural gas. And then it's renewable energy is a bunch of different things, but then we use coal and we use nuclear power. But we haven't been really building nuclear power plants. And so right now, Tony Robbins does a good job of explaining, like, there are people who are environmentalists. Listen, I care about the environment, right? I would love for us all to use, renewable energy resources. But what we're starting to discover, solar panels, batteries of EV cars, those take a lot of different minerals from a lot of different countries, cobalt and all this other stuff. And they're mining those materials in like Africa, and almost like slaves are like, practically, but these are very poor people digging the mud with their hands, trying to get these natural resources to help for our batteries, and they're living off like, slave wages. And it's like, ooh, we're thinking that we're going green, but we're actually really harming, the people. And so we have to re-examine this whole thing that of what we think is really clean energy. But again, if it was really legitimate clean, well, look at all these different sources that are renewable energy. We are not, and this is what Tony Robbins says in this book, we are not going to be able to get out of our energy crisis or provide the energy that we need on just renewable energy alone. We need all of it. And so I can go on a whole tangent with that. But here's what he says. Demand for all types of energy is growing. We need more coal, more oil, more gas, more nuclear, more renewable. He says, like, China's building so many nuclear power plants right now, like, it's unbelievable. They're also building coal, power plants and things like that. And so here's what the big debate is. The challenge is, how can we grow our supply of energy without causing more pollution? Now, some extremists, maybe on the environmental side, will say, no oil, no gas, no coal. And it's like, well, I know, but that may be extreme. Certain companies, and he gives example like Germany, basically shut down their coal power plants, right? And guess what happened? With the Ukraine crisis, they basically, were depending upon natural gas from Russia, and all of that spiked up in price. And it's like, oh my goodness, we have to like burn our coal power plants. Now we're not getting cleaner natural gas. And so, oh my goodness, the same thing happened in New York, where basically we shut down Indian Point nuclear power plant, which is in New York State, because we're like, ooh, nuclear, that's dangerous. We could have contamination. But guess what? We shut it down, but we have more and more energy demand. So what do? We start burning more coal, start burning more oil. So it's a little bit dirtier. So again, the struggle is we need to get to somewhere we can have clean energy, less pollution, as well as meeting our demand. So for Tony and what his research show is that, guess what? we're going to need more energy, and so it's an investment opportunity. So there's so many different reasons. Now, companies are not, drilling for oil in new places. So, but they're not, banks are not giving them money, but guess where they're getting the money to help maintain and support those oil rigs? They're getting it from private equity, right? So 50% of the funding comes from private equity for the oil rigs in the US. Oil and gas companies right now are considered undervalued. So guess what? That's an opportunity, right? New oil refineries no new oil refineries are being built. So that means the same location that has to refine this thick oil into natural gas, fuel and for our cars and things like that. Well, it's only limited places. So that means that if we're going to have any shocks, it's going to be really bad for the consumer because we don't have any more oil refineries. So it's going to be sucky for the consumer, but according to Tony, that's going to be good for an investor if they are responsible or own a piece or are investing in these refineries. Another big thing right now is the liquefaction of natural gas. Natural gas is great. It's much cleaner energy than burning coal or oil. But guess what? We at the United States have the ability to compress that in very, very cold environments, and then we can transport it easily. So this is going to be a big thing because there's a demand. Private credit is being used for energy industry, but banks are less likely to give. Why? Because they have zero net energy policies. They've been succumbed to the pressure from the ESG and the different environmental nonprofit groups. It's like carbon dioxide is evil, and so we don't want to support anything that of energy that causes carbon emissions. It's like, well, we have to fill the need somewhere. Guess we're going to get that money from private credit, not from the banks. And so there's also new cutting edge technologies. In the book, he talks about how there's they're able to have a coal power plant and take those fumes and those CO2 and then repackage it and reuse it and turn it into graphite or have zero emissions. And so again, would you guys all want to be able to use coal if the United States has a 300-year supply of coal and we're able to extract it and do it safely and cleanly with a new cutting edge technology? I'd be like, oh, that would be good, right? As long as we're not harming the environment and we can use it and safely, great. So again, there's so much that's coming out there. So this, according to Tony, is a great place to start investing. And then I'll just do a little side tangent. Tony didn't mention this in this book, but I'm going to give this out as an additional resource. There is a very, very powerful documentary called The Lost Century and how to reclaim it. This is a documentary that was done by Stephen Greer. He's the one that I've shared with a lot of the community that did the documentary Close Encounters of the Fifth Kind. He was a medical doctor that has retired, and he's very interested in the UFO phenomenon and basically believes that that there is extraterrestrials that have always existed. They have technology, but they view us as a species that is very violent, right? And we've had access to a lot of these clean technologies, but guess what? There are powerful interests that don't want us to have access to these technologies. So in this documentary is all about, we could have had cars running on water because there was a lot of scientists that did. Just think about it right now. If tomorrow, if you found out that you could power your home and you could power your car on none of the fossil fuels, not gas, oil, anything like that, wow, how amazing would that be? But guess what? That is a threat to it would cause a collapse in our total economic system because so many jobs and so many things depended on that. So it would need to be done gradually. And so I think we're going to get to a point where new technology is going to come out. So, and for those of you who are level 3 members, are able to see in one of my trainings, I did a training called, forecasting the future, and what's going to be happening. And we're going to see a lot of different changes, especially around the year 2040, where, cars are not going to be running on combustion engines. There's going to be a lot of other energy sources that are going to be supplying our energy. So I'm going to send this documentary as an additional resource, but I thought it would just be fun to really mention it. And I thought it would be very interesting for those who want to learn more. Okay. The fifth, alternative investment is venture capital. So whenever you hear the word VC or venture capital, I want you to think of startup companies. So I got this little image and I thought it was so funny. Here's a image of a venture capitalist, somebody who invests in a business venture. So here's, you have an little example of this kid named Sam. He has an idea. I have a big business idea that we can make a lot of money. He goes to the bank, boom, he's rejected. They're like, you have no history, you know, whatever it is, we're not going to give you a loan. But he goes to his auntie and he says, Auntie, can I please get a loan to start this company? And they're like, Auntie says, here's $1 million, but guess what? There's a catch with this $1 million. I want to own 50% of the firm, right? And so now the auntie is a venture capitalist, right? Also, she's an angel investor, but it's a way of making money for people who don't have the capital, have great ideas, to be very profitable. Now, what's the challenge with venture capitalists? 9 out of 10 startups fail within the first 10 years. Okay, I think it's around 80% with if that fail within 3 to 4 years. So how can venture capital even be successful? Well, according to this, there are several reasons why, right? If people have really deep pockets and a lot of money and they can diversify among numerous companies and numerous sectors of startups and they kind of do their due diligence, well, guess what? Chances are they could invest in a good thing that could give them a lot of return, a lot of reward, a return on investment. The other thing is longevity. Funds are constantly being launched every 2 to 4 years. And, there are cycles, throughout history, like you saw in the last leadership library training about financial crises and the economy, where I showed a clip of Ray Dalio, where sometimes, we go through inflation, we go through deflation and stuff like that. There are different environments where, it's easier to have a startup. There's easy capital. So you'd want to take advantage of that. So by constantly creating new funds, you're getting new opportunity to new businesses to invest in, right? And then the last thing is wisdom, guidance, and money. So some of the best VCs, there are certain companies that really invest in startups. They give money to them, and guess what? By them giving them money, they're showing when that business is going around, even to either get more money. It's like, listen, we're backed up by this very experienced venture capital firm. So that gives us instant credibility, right? And they're going to connect us to their network, get access to different resources. They're going to help us ensure that we become successful. And so that's what's really, really good about venture capital, very, very smart money, that it's jumping into a risky thing, but because of all these different things, they can help minimize that risk. And then number 6 is private real estate. I won't go into that, but again, it's just a way of investing. Different firms that invest in homes, invest in apartment buildings that they can take advantage of. And then the last one is secondaries, right? Assets that are on sale. And so there are a lot of different things that could be secondaries. You could basically have stocks, bonds, or cash. This has to do with this concept of, like, the best analogy would be, imagine you bought a brand new car. Okay, it was a Ferrari, right? And it was worth, I don't know what a brand new Ferrari costs, $200,000. Okay, but the moment that person drives it down the road, they suddenly say, oh my goodness, I need to move. I have a change in my family. What they need, that money fast, so they decide to sell it to somebody. Hey, can you buy my car? It's a brand new car. It's 200,000. Could you give me like 160 for it? 175, just whatever it is. Okay, fine. Well, that was buying low. That was a smart investment because you bought an undervalued asset. Now, that was just using a simple analogy with a Ferrari, but you could do this with stock market capital allocations, where the moment that something happens, a lot of wealthy people will try to have balanced portfolios. So suddenly that means that it's like, ooh, I want a percentage of gold, I want a percentage of this, and they'll say, oh wow, my gold portfolio or something like that, or the stock market has declined precipitously, and it's like, I need more stocks for that, I need to balance my portfolio. I'll just sell my gold holdings, or I'll sell my stocks because I want that balanced portfolio. So the moment that wealthy individuals are trying to sell their stuff and they need to sell it quickly, well, for the smart, savvy investor or consumer, they can use that as an opportunity to buy an undervalued asset. And this also has to do with private equity as well, where companies invest in private equity, but they suddenly somehow, hey, that money's supposed to be locked up for many years, but they're like, but I need that money now. Well, they'll allow other people in certain periods of time to say, well, you can actually sell your ownership to somebody else. So that would be a secondary sale, right? So again, he goes in a lot more detail about this for you to discover. And so what I've just covered for you in those 7 different areas of alternative investments, I've just covered the first 150 pages of the book. Okay, just in that summary. And I could have gone into much more detail, but I didn't because there's so much more. The rest of the book is all in-depth interviews of some of the wealthiest people in the world in hedge funds, private equity, venture capital, and things like that, giving their advice. And I haven't read that portion of it, but I plan to read it. So I'm really excited to see what lessons there are. But there is something else that I wanted to end this training on for you guys on. And that has to do with the one final chapter of the book that I kind of skipped ahead because I really wanted to read it. And it's what Tony Robbins says is what is the true holy grail of financial freedom. And he used this analogy, and I'd like for all of you to really think about this. If you had to choose, okay, you could be the person on the left or the right. Would you choose to be a person who has $1 billion worth of assets? You own a luxury car, very, very nice car. You actually go on a vacation every year, but you're really frustrated, right? You're really angry, you're stressed out, you're worried all of the time, you have so much pressures from your job to keep up with the Joneses and stuff like that. You're living this amazing life, but there's a lot of high stress and a lot of anger and frustration. Or would you rather be a person that doesn't make a lot of money? Let's just say you make less than $50,000 a year. That's not a lot of money, but you don't have a luxury car, but you have an economical car. And because of your financial situation, you don't get to really travel as much and go to the Bahamas or whatever, but you have high quality relationships with your friends and you spend time with them. You're happy. Why are you happy? Because you're actually doing your meaningful work, right? That you're really helping people. You're doing something. You're learning and growing. So what do you want? The person on the left or on the person on the right? And to me, that's a very powerful analogy. And I would say I can just speak to myself. I think everybody here in Electa Society would probably choose the person on the right. That person who's living a happy, fulfilled life. I don't want to live life full of anger and stress, and I have all these different responsibilities. But does that mean that we have to be poor to be happy? No, but it's a choice, right? It's a matter of whether you feel grateful. There will never be enough money to buy all the things that you want to have. And so one of the things that I've really learned is, do you rather be a rich person and miserable or a poor person that's happy? Well, I'll be a rather poor person that's happy, but if we're living this game on making money, and these trainings have all been about financial investments and things like that, there are only a couple ways for you to build and create wealth. Number one is you spend less money. How many times do we waste money buying luxury things that we don't need, eating out that we shouldn't do, when we could probably make the food that's much healthier and better for us, going on vacations that sometimes are like, ooh, I went to all these things and I posted pictures on Instagram and I look how cool I am, but you come back from the trip exhausted and you ate like a pig and now you got sick because you ate out and you partied so much and drank too much alcohol. It's like, well, where are our values? Where are we? We're missing the boat here, right? On what really has happened. So number one to create wealth is spend less money, buy in bulk, don't eat out, like all these different things, like a game. The second is you can make more money. How do you make more money? Well, whatever job that you're doing, you add value. If you add value for your boss, your company, your business, your nonprofit, they're going to want to pay you more money because you provide more valuable to the organization. So continuing to grow and adding value makes businesses want to pay you more because you're providing more value. That's it. So those 2 ways. And then the third way is with that money that you've gotten, that you've generated by adding more value, you are responsible with that money and you invest it. And you invest it wisely and you get control of your emotions and you invest it in all the diversified assets, including these alternative assets. So That's it. That's that's the summary. So this is what Tony Robbins says is the true Holy Grail financial freedom. It's loving warmth of our relationships with our friends and our family. If you have a lot of laughter, if you're happy, if you're finding meaningful work, and your capacity to learn, grow, share, and serve. And what are some of the actions you can do? Is tithing. He's big on that. Giving to others in need. You know, sometimes people always say, well, I'll only give money when I'm wealthy. Well, guess what? You're adopting the mindset of scarcity, that you are too poor to be able to actually help and contribute. And you don't always have to donate money to different causes. You can donate your time, your talent, your love, your compassion, your heart. You know, all that stuff makes a difference. So shift your mindset from scarcity to abundance, right? Have gratitude that you're alive, and have, you know, and that you have freedom. You know, if you just live in the US, you have more freedom than almost any country out there. And you're so lucky. You know, people would beg to be in your position, even if you're poor. There's so many people in other countries would die to be in the situation that you have. And so different actions that you can do: daily prayer, daily meditation, gratitude journal. That's what you need to do. Okay. So that's the end of the presentation. Oh, and if you give more, you always receive more, you know. And how you can give: volunteer, do whatever you can do. Remember, this is Electus Society. All these trainings are for free. If you want to help give back, help support us to help grow Electus Society. But don't donate to us. You can donate to other causes as well. Okay. So that's the end of the training. At this point, I'll take questions and or comments. And if you fill out the post assessment, you can give me feedback on this training, what I could do to make it better. You know, what new action steps are you going to take? And I'll also say, while you guys are thinking up of different types of questions to ask me, in the book, remember this book, The Holy Grail of Investing, you know, Christopher Zook is the co-author, and he is I guess the founder. Don't quote me on that, but he's responsible for CAZ Investments, CAZ Investments. So I actually, a lot of the different things, it's like, well, what if you want to invest in sports teams? Or what if you want to invest in private equity and you don't know how? Well, all those websites, if you go to CAZ Investments, CAZ Investments, or, you know, why these different things, guess what you can do? It will take you to his website, and you can say, hey, I'm interested in doing private equity or venture capital and things like that. And it sends you to like a new website called CAZ Strategic Opportunities. And I clicked on it, and you can log in using your email and stuff like that. And it asks you questions. It says, all right, are you an accredited investor? Do you have more than $200,000 to $300,000 in investment income? You know, and then if you don't qualify, then guess what? You can't invest. So I didn't hit the I don't qualify. I just wanted to see what would happen. And I clicked on I have $200,000, $300 income. And then it basically says, okay, now you can learn about these opportunities, and you can start, sending money so that you can start investing into these things. So again, I don't know. I'm assuming that most of the people here don't have between $200,000 and $300,000, but there are other different investment opportunities. It's something for you to strive for. And if they do change the laws, well, guess what? We might be able to become accredited investors by either simply taking a test, or if Congress and the president pass some kind of legislation. So just thought I'd keep you guys up to date. So okay, so I'm just looking at some of the comments. Yes, so the chat for the post assessment, I'll repost it right now. Hold on. I'm going to send this to everybody. Meeting group chat. Here's the post assessment. Let's see other comments. Thanks, Tim, for the great information. Thanks so much, Henry. I appreciate your comments. Zohab, if you can't scan the QR code, then just try the link. I know that if you're watching this on your phone, you can't really take a picture of the phone, but if you click on the chat, there will be the post assessment. And I'm going to send out this recording tomorrow. So for those of you who, I'm grateful for the people who are able to attend live, but for the people who are going to watch the video recording, I'll also include a link for the post assessment, so you can download a copy of the PowerPoint. So does anybody else have any questions or any other additional comments? I might call on some people. Yomerly, do you have any kind of, Oh, and I'll go to Shirley first because I saw Shirley raise her hand. Shirley, thanks so much for raising your hand. What's your question or your comment?
I was going to say, what's the bestest way of like saving money?
Okay, so that's a great question. So to me, based on what I have researched and have seen, the best way to save money is to pay yourself first and pretend like it doesn't even exist. So for example, in the first training, Creating Wealth and Abundance, My Stories of Success and Failures, part of the additional resources, I give you a budget sheet, right? And it's annoying to do a budget, but what you need to do is realize is where's the money coming in and where's it going out. And there's a lot of things that you can do. So the easiest ways that I have been able to save a lot of money, like I said before, is not eating out, buying in bulk. Instead of buying cans of beans, you can buy a bulk of dry beans and cook those yourself, like in a pressure cooker. Instead of buying name brands, you buy commercial brands. Like if you go to Whole Foods 365, if you go to Costco, you buy Kirkland brand. All those regular items are always much cheaper than the actual. Why? Because they don't have to pay advertisements and things like that. Find out where you're spending money and plug those holes. I mean, this is kind of even extreme, but my wife and we don't even buy laundry detergent. We make our own, I have to do the math, but I'm pretty sure it's like about 30% cheaper. Again, we have to get, washing soda, Epsom salt, iodized salt, baking soda, and what else is in there? And then we add some essential oils and then we mix it all together and boom, one little cup of it, that's that's laundry detergent. We do that for health reasons as well. But again, you'd be surprised if you think of life as a game of how I could save the most money. You could crank things out like you wouldn't believe. Stuff like you've been buying bread. You could even make your own bread. That I've tested out doing, and things like that. So just so many things that you can save money. So then, what you do is once you're able to cut down your budget, and really, what you have to do is money has to be automatically siphoned off that you don't see. Because if you see it in your checking account, guess what? You're going to use it. You're like, it's there. But if you pay yourself first and say, okay, in my checking account, I would like, $100 a month, to go into whatever Fidelity investments or some kind of S&P 500 or whatever. And so I just wanted to, this is called dollar cost averaging. I don't want to see the money. I just want it to be siphoned off, right? And the other things that you could do, it's so easy to send up multiple checking accounts. My wife and I did this at one point where we were like, why don't we have money sent from our checking account to a different account, right? So this will be our clothing account. This will be our vacation account. And so it almost like it didn't exist because you don't see it. And some people could also do it with envelopes and cash where it's like, okay, you know what? I got paid this week for my job. Pay myself first. Boom. I'm going to put this towards my investment fund, right? And so this is all I have left. So is that helpful, Shirley, to do those kind of things to help save money?
Yes, that's really helpful. Thank you.
No problem. It was a great question. And there's so many other things. There's also a bill negotiator that like right now you're paying your phone bill. What if you could actually lower it? And I think I put it, if you look at the first training, I may just resend those trainings, but if you could just click on that and additional resources, I'll give you the links. They'll call those companies up and say, hey, Shirley's paying too much for her cable bill. I would like it lower. Can you give us some credits? What can you do for us? And they might just give you $10 less in your cable bill, but you wouldn't know how to do it. You would have to be on the phone several hours, try, negotiate, but because they're experts, they can do it. So if they save you $10, guess what? Now you save $10, but now you pay this company $5 for negotiating your bill every month. So you'll pay them $5 every month, but you've saved $5 a month. So again, that's called a contingency-based, bill negotiator. Lot of other kind of stuff like that. And then add more value, make more money, and then as you make more money, you got to raise. Don't celebrate. Try to still live beneath your means, right? And how can I siphon off that more money to do that? Okay, great question, Shirley. Any other question or comment? I think I was going to ask Yomerly. Yomerly, I saw your chat. Thank you, Tim, so much for the valuable information. You're welcome, Yomerly. I'm happy to share it with you and the rest of the Electus Society community. Is there anybody else that would like to give a final comment? How about Zohab? You there? You might be on mute, or it might be there's something. Henry, you wanted to have the last final word? Henry, are you there?
He's coming. Yeah, I'm here, Tim.
Any final comment?
There has to be a part two
What's the part two?
to this session right here. I put that in the form, the post assessment
Okay.
recommendation that you maybe do a part two to this.
Okay, well, that's a good idea. I'll take that under advisement because I still have to finish the second half of the book, which is all about the information of what all these millionaires and billionaires said in his interviews. Again, the first half of the book was all these principles. So if I do find it valuable, I'll definitely do it. Otherwise, Henry, you and I can connect and we can talk about it. But yeah, there's so many other topics that I love to cover. And remember, we're trying to do a leadership library series like once a month. I know that it's summer of 2024. I do want to kind of redo levels 1, 2, and 3 for all the new members. So that's going to be exciting and taking some time. But I will make sure that all the members are engaged with these monthly leadership library series that we either tackle another book or this. So thanks so much, Henry, for the feedback. And I'm glad that you want more of this stuff.
Yeah, just let me know, Tim. Sounds good. Maybe we can collaborate again.
Sounds good. All right. Shirley, you raised your hand?
I agree with what he said. I think it would be so good just to have more information about this and just be able to expand more on this idea. I felt like I learned a lot.
All right. Do you like just about this topic of investing and stuff like that?
Yes.
All right. Well, you know what? I'll take that because guess what? There was a training that I wanted to do with a certified financial planner that is an amazing guy. I'll see if he's still available because I love to. We were planning on doing a training just to help general people how to, get out of debt, how to do different things. I'll see if he's available. But if not, no matter what, there's a lot of other videos and resources that I can provide and which he gave to me so that I can also, if he's not available, I can do another training on this. But maybe you guys are right. Maybe, financial freedom is such a big topic right now with the economy stagnant that there might be a lot of different things that the members are really wanting. And if you guys keep telling me and give me feedback, send me emails on the different topics that you want, specific questions and concerns, or have amazing stories. I'd love for you to include yourself in the discussion, add to the presentation, and that we can help support our community. Okay? So
I got one.
all right, go ahead. Go ahead, Henry.
Would it be too much to go over right now, this this whole thing with the election, like age? I'm saying as far as leadership when it comes to age. I mean, is there anything you could put together on that?
Well, tell me a little bit more about that. Well, what would be the topic? Well, this election is huge, right? I can give you kind of my 2 cents on this election. It's going to be very interesting. You have to think about it of the best case, the worst case scenarios when it comes to this election. Is that what you were talking about?
Yeah, particularly the election, but I'm thinking in terms that is there a limitation on when it comes to age when someone has the capacity to lead this the greatest nation on earth? Like, is there some type of way we can determine is one still able to do that, because I know me personally at that age, I'm thinking you have a hard time remembering a lot of personal things, let alone what the job entails. So yeah, I'm just curious, Tim.
Oh yeah. You're talking about age. Like, for example, Biden and Trump, are both in their senior years. And in the last debate, there's been a lot of criticism of Biden and stuff like that. Well, here's my only caveat, right? As you know, I really identify myself as an independent because I think I shared with all of you is if I attach myself to a political party, I then can kind of be distracted or succumb to supporting ideas because that's what the party wants when I actually want to have an independent mind and think and say, okay, what policies, things are working, that on the left side or the right side, what is the best side, right? And so in order to do that, I need to be objective. And the third thing that I have to do is, again, Electus Society is a 501c3 non-for-profit, right? Because we're trying to grow and expand. We cannot endorse kind of any other candidates, which I'm kind of happy about, because a lot of our members could be conservative, progressive, liberals. Everybody's welcome, right? We all have different ideas. There's no judgment, right? And so it's like, okay, so I don't want to endorse or put any candidate out there. However, I do, as leaders, we have to evaluate, what are all the different categories of different topics. There are the president is responsible. I think I did some initial research on this, like 16 different categories. They're responsible for healthcare, right? They're responsible for whether a country goes to war or not. So that's our defense. They're responsible for the economy. They're responsible. So there's all these different cabinet positions that a president is responsible for. And so, voting for a candidate, if you're going to be a conscientious voter, you'd have to say, okay, based on all these categories, okay, what are my policies? What do I believe in? And how do each of these candidates fit and are likely to complete that policy that I really care about, and be very discerning. We did a training a while back called Leadocracy, and I did it about 2 years ago. It was based on a book by the guy big corporate leader, who basically said that we have to reevaluate the way we actually choose leaders. And it was actually a call to people to say, guess what? We need more smart people like you and me to run for not to run for political office, but to get involved in government. Why? Because the people who are attracted to government are usually people who, could be a little bit of narcissistic, right? To think about that. A lot of smart people are like, I'm not going to get in government. But he says that there's a lot of different positions in government that are appointed. The biggest fears about you running for an election are, hey, are you going to, talk about my personal business, right? Are you going to, is it worth it? I can make more money, in the private sector than I could do making government. But this book was really about, we have to be more discerning when we come to politicians. We can't go based on what their looks and what they feel like. We have to say, okay, what do we want them to accomplish? Kind of like a job interview on these categories. Are they likely? Do they have any experience doing exactly that? And if we could look at politicians that way versus, oh, I just like the person, I could have a drink with them, then we would elect a lot better leaders. And so I'll send that as an additional recording that I think a lot of people should watch, especially because I even talk about some candidates in there that might be running for election in this upcoming election. So I'll send that out as an additional resource as well. So thanks for bringing it up, Henry. So yes, please give your feedback to me. Feel free to shoot me an email. You guys all have my emails of different topics that you want me to cover in the Leadership Library series, and I'm happy to discuss them and cover them. Okay. So it's past our time. I wanted to thank you all for your comments, for your feedback, for those people who are watching this live, and for those who are watching this recording. Thank you so much. Have a great night. Bye-bye. Bye-bye. Thank you so much for watching this video clip about conscious leadership. If you are committed to helping to create more conscious leaders in this world, that is, leaders with more humility, more integrity, more awareness, that take constructive action, then consider helping us by making a donation. Our goal is to have 600 conscious leaders develop before the end of this year. Currently, as of December 1st, we already have 400 members. And again, with your help, we can grow even further. How can you help us? Simply make a donation. If you visit buymeacoffee.com/Electus Society, you can either choose to give a monthly donation and join, and you get different access to a lot of these different membership benefits, or simply make a one-time donation. Click on the heart support button, choose 1, 3, 5, or type in any amount of coffees. Hit the support button, and you can upload your card information on the secure platform. Thank you so much. I appreciate you, and let's continue our mission of building more leaders. Thank you so much. Bye-bye.